All right. Good morning, guys. All right. Good morning, guys. All right. Good
Alright,
morning,
good morning.
guys.
Alright, good morning, guys.
I want to believe we're all
Alright, good
doing.
morning, guys.
I want to believe we're all
Alright,
doing.
good morning, guys. I want to believe we're all doing. I want to believe we're all doing.
Sorry. Okay. I think we're working now. Yeah. So I want to believe we're all doing good today, and we had a very wonderful weekend. It's nice to have us all again for another trading week. Apparently, we've come so far, and there's still a lot to do. So today again, we're having our guest, our speaker, in person of Mr. David. We welcome you, bro. Thank you for all you do. So today we're going for another session, and today will be his last time with us. Then from there we'll continue to our next speaker. That will be Mr. Toby, a G7 trader in the United Bank of Africa. He should be a trace for Tony Enumelu. So we'll be having him from next week. We'll be having him from next week. So let's us prepare ahead. So, Mr. David, are you ready now?
I'm ready, sir.
All right. Thank you very much. Take over.
Okay. So I believe you guys can see my screen now. So last week, I actually talked about a particular topic on liquidity, which was the external liquidity, which is all about buy side liquidity and sell side liquidity, internal liquidity. Okay, so take. I'm not going to copy all the topics of the internal liquidity, but I'm going to look actually inside one or two of it. Okay. So here we are in internal liquidity. Okay, so the first thing we have here is the definition, the explanation, why it works, and some examples of this internal range liquidity. Now, that refers to the liquidity within the current trading range. This is in contrast to external range liquidity, which is found outside the current trading range. Okay, so like I explained to you guys on Friday, I was telling you guys that internal range liquidity is found within the range, and external range liquidity is found outside the current trading range. So, explanation of internal range liquidity. Internal liquidity involves the filling of liquidity void, fair value gaps within the existing trading range. Okay, so if you are not familiar with the word liquidity void and fair value gaps and vacuum, all these are gaps that you can find within the current trading range. Now, for instance, if you go into your chart, you look at some pair like Europe USD, GBP USD, you will notice that those market open with gaps in the market. So the reason why the market open with gap because of the liquidity behind it. So this liquidity is what we refer to as internal range liquidity. Okay, this gap these gaps are areas where the market has quickly repriced, leaving little to no trading activity. When the market is likely to stay within its current range, these void and gaps tend to fill in, which is associated with gap risks. Okay. Now, why it works? This concept works because the market seeks to balance itself by filling in these gaps, ensuring that there is a more even distribution of trading activity. This behavior can be predictable and thus can be used by traders to identify potential entry and exit point within the range. Okay, so I'll go to trading view here to show you some quick example of this trading gap. Or I will So even currently here from the chart I am right now, there is a gap here. The price just reprice and price is going up from there. But I would love to show you the obvious gap. So the obvious gap we have here is this one here I marked out yesterday. So if like for instance, if you go to my Twitter, I updated it yesterday night talking about this gap and the reason why we have such gaps in the market. So when we see gaps like this, we refer to them as internal range liquidity. These are gaps in the market where price come back, refeed them, and then price distribute. And here these are gaps in the market. So the difference between this internal range liquidity and external range liquidity is very simple. Internal range is the one within inside the range, and external range is the one outside the range. Like for instance, you see this horizontal rail line I just placed here is external range liquidity. You see price here is external range liquidity. Now, why is it external range liquidity? Is because let me open it. Why is it external range liquidity? I will change the colors, okay? So this is just for the class purpose. So just bear with me. So why is it external range liquidity? It's because buy stops and sell stops reside on these places. Okay. Okay. I don't have this note. It's because buy stop and sell stop reside on these places. Here we have buy stops. Like I explained last week when I was talking about all this the meaning of buy stops and buy side liquidity. I referred to you guys as those places whereby traders were selling off and their stop loss was being placed. Here we have what is known as sell stop liquidity. Okay, we have sell stop here and we have buy stops here. So in this area or in this case scenario, what do you expect the market to be doing? So if the market is within a range and you're expecting the market to sell, you're expecting it to come below a old low, a previous day low, a previous week low, a previous month low, or whatsoever low it is that is outside the current trading range. That is what we refer to as sell side liquidity. And the one we refer to as buy side liquidity is the one we find outside the upper side of the current trading range. And then when we are not talking about internal range liquidity, internal range liquidity is what the market is who I price come back to refill before price drawing to an external range liquidity. For instance, here we have buy stops and sell stops. Here is buy stops and here is sell stops. So like I said earlier, I might not be able to copy gaps means in the market. Here is known as internal range liquidity. Is known as internal range liquidity. This is one of the example of the gap. So like I said earlier, I might not be able to copy gaps means in the market. Some of them are in different ways, while some of them are also in different ways. So like I said earlier, I might not be able to copy gaps means in the market. Some of them are in different ways, while some of them are also in different ways. So like I said earlier, I might not be able to copy gaps means in the market. Some of them are in different ways, while some of them are also in different ways. So just as for example, we have this known liquidity, this one like this. These are not fair value gaps. This one here are known as liquidity void. Okay, so mostly the kind of gaps you be seeing in the market are the void, whereby it's a one-way displacement, or a gap that price gap this candle and open to maybe to the downside or to the upside, but it did not open at the close of the other candle. That is one is known as vacuum block, and the one that is just within a displacement of one candle to another is known as a fair value gap. Okay, now let's go back and take why it works. Now the concept word, because the okay, I've already taken it, but let me retake it again. The concept word, because the market seeks to balance itself by filling in this gap, ensuring that there is a more even distribution of trading activity. This behavior can be predictable and thus can be used by traders to identify potential entry and exit point. Now, example, for instance, if the market has a gap between the low of one candle and the high of another candle within the current trading range, this gap represents internal liquidity. The market is likely to move back into this area to fill in the gap, providing a potential trading opportunity. Okay, so types of the gaps we have here, we have fair value gaps. So when we talk about fair value gap is a concept introduced by inner cycle trader ICT himself, Michael J. Woodson, which refers to a specific range in price delivery where there is an imbalance between a buy side and a sell side liquidity. This gap typically appears as a void or vacuum in trading activity on a price chart. Now, for the explanation of the concept, a fair value gap occurs when the market moves quickly, that it leaves behind a gap between the high of one candle and the low of the next candle without trading occurring in between. This gap signifies that the market did not have sufficient time to balance by and sell orders, creating an inefficiency in the market. So the next one on our PDF here, we have we have something like this in the chart. So like here, I have a clean chart of Euro USD with the fair value gap example. So and then the other below here, I have where I label it here. Now, when you look closely, those candle range would see a price gap between it. The price gap between this closure of this candle and the opening of this candle is known as fair value gap. You might not really see it because it's kind of blurry, but let me use the reacher to show you what we are talking about. So when we talk about fair value gap, we are talking about the trading activity that occur between the closure of this candle and the opening of this candle. Okay, so as you can see from here, what happened here when this candle close up here, the next one open here and it fill in this gap. Here we have this little gap here also, right? But that is already being filled and price delivered to the upside, took out the liquidity he wanted to take and decided this is going to the downside. Now from here we see the closure of this candle. Now this candle here happened to open, but it failed to trade back inside of this candle, and then price just kept on going down. Okay, when price does something like that, he has leave in a fair value gap in between that two candles. Okay, in between this closing candle and this opening candles, price has leaving in what is known as a fair value gap. So what do you intend to do? You intend to wait for price to come back and reprice it, and from there you can take your short opportunities. Okay, so there's one thing you need to know: these gaps are actually not what the concept I'm teaching right now is just for analysis purpose. I'm not teaching you entry models of this concept. So when it comes to the entry models of this concept, it's different on how you approach it, what time you approach it, and how you take the trade. But this is just a way on what I'm teaching right now is just a way on how to go about reading the market. Okay, how to go about analyzing the market and knowing what the market is doing at the moment. So the next one on our PDF here, we have okay, let me just take this one, tips in using the fair value gap. So first of all, you have to identify the gaps. Looks for gaps on your price range are considered stronger and more reliable. Now, the ones that are not within a balanced price range cannot be considered strong, okay, especially when we are in a choppy market and price is consolidating. So those type of fair value gap might not really be effective on the price, but the one that are on a more balanced price range where you can see that the market is delivering either to the upside or to the downside, those ones are considered strong and more reliable. Now, time frames, fair value gaps can appear on various time frames, but the significant may what is that right here? Okay, the significant may vary. For instance, a 5 minute fair value gap cannot a 5 minute fair value gap might be less impactful than the one on a daily chart. Okay, so the one on daily chart might actually deliver the whole day activity of what the next day is going to be like, but the one on 5 minutes is not really going to have a strong effect like that. So to the next one here is the note on using fair value gap. Now, not all gaps will fill quickly, so some fair value gaps can remain open for days, months, or even years before the market will revisit them. So mitigation of this fair value gap, you have to be cautious of misidentifying gaps. I see mentioned that you have to correctly identify fair value gap, which can lead to poor trading. So you have to do your own work by backtesting to know the kind of gaps you'll be working with and the kind of gaps the kind of gaps in a balanced range for you to trade with. Okay, understanding and correctly identifying this fair value gap can be a powerful tool in your trading strategy, helping you to anticipate potential price movement. Now the next one here is void. Okay, we have the void here. So the next one here is void. Now, a liquidity void is a concept in trading that refers to a range in price delivery where there is an absence of liquidity on one side of the market. This typically manifests as wide or long one-sided price movement. Okay, I repeat, it typically manifests as wide or long one-sided price movement. When I mean long, when you see a long candlestick, price just delivering to just delivering to a one side and not going to the other side. That is what we refer to as a void. Often seen as a large candles on the chart, this movement indicate that there were very little trading activity on the opposite side, creating a void in liquidity. Now, explanation of the concept: when the market moves aggressively in one direction, it leaves behind a range where there was little to no trading activity on the opposite side. For example, if the market drops sharply, it creates a void of buy-side liquidity, meaning there were very few buyers during that top. This is what is referred to as a liquidity void. Now, why the concept works is here also. The concept works because the market tend to revisit this void to fill in the gaps where trading activity was sparse. This is driven by the idea of the market equilibrium and will often return to areas of previous imbalance to balance out the other flow. So, like the days you can be expecting a liquidity void is very close. Like on Friday now, you can watch this chart. You will see how price is going to deliver to one side, to one side delivery, and this might occur if the fundamentals they are expecting come out as expected or comes out as lower than expected, and it's not be mixed up with other fundamentals. Okay, so if it's not being mixed up with other fundamentals, we are going to have one-sided delivery. But if it's being mixed up with other fundamentals that can delay the movement, we are not going to have that one-side and price delivery. Now, when you go back to Trump inauguration, you will find out this price delivery I'm talking about. There were huge price delivery on Trump inauguration. Okay, now let me go to 1 hour. I think that was December 20th. This is January 2nd. Okay, yeah, this is it. This is the candle I was looking for. This is the candle I was looking for. So when you see such candles like this is what we call as liquidity void, where price just moves towards one direction. For instance, price like this is what we call a liquidity void. Okay, this is what we call a liquidity void. As it's been as I read to you guys, as I gave you why it works and the reason behind it is that when you see one price delivery like this to an upside, is because there were little to no trading of the opposite direction. So this will cause the price to actually deliver to an one-sided price movement. Okay, when price does that, what you have to do is for you to wait for price to come back and fill in this gap. Okay, it might not fill it completely, it might fill it half percent way, or it might fill it and react to any POI that it can react from there and begin to buy. Like for instance here, it came back filling in this gap and then reacted to this breaker and then price started shooting up again. So that is what a liquidity void means. Okay, for instance here, this fair value gap on the 4 hour on the lower time frame here, it is also a liquidity void. So here is not a liquidity void, here is a vacuum block. So that is for the internal range liquidity. Now I still have a graph here. What can you see in this chart? For what I just showed you on the reach chart, on this graph that I put here also, this what refers to as a liquidity void, a one-sided price movement to a direction. Okay, once you see that one-sided price movement to a direction, quick sharp price movement to a particular direction, or price delivery to a particular direction is known as liquidity void. Okay, as you can see there, I went out labeling it, showing you liquidity void. Now what do you see now? It's very simple for you to identify liquidity void. First of all, there will not be mixed up candles. When I mean mixed up candles, you are not going to find buying and selling candles in that area. If it is only buying candle, it's going to be only buying candles. If it's only selling candles, it's going to be only selling candles. Okay, so the next one here, I show you how price came back to refill in that void. Okay, you see the void price sold out, and then we have a vacuum block. Price took all this time filling in. Price took all this time going to the downside, and then later on, price revisit back this liquidity void, filled it completely, and price sold from there to the downside. Okay. Now, also for tips of using the concept, you have to identify the void first. Look for areas on the chart where the price has moved aggressively in one direction, will lead to no trading on the opposite side. Okay, anticipate a revisit, understanding that the market will likely revisit this void to fill them in, although the timing can be uncertain. Okay, so I can't really tell you that if a void is being created, you should come back in the next 1 hour, it will be filled. It can take months, it can take weeks, it can take days, it can take minutes to refill it, depending on how the market is moving. Now, use in conjunction, combine the identification of liquidity void with other market analysis tools to improve the accuracy of your prediction. So you do not just rely on internal range liquidity, you have to also rely on POIs and other stuff to use to improve your trading predictions and your trading skill. Okay, so going to the next one here is the note. So I already talked about time uncertainty. I also talk, okay, let me talk about market condition. The likelihood of a void being filled can depend on the market condition and the presence of the smart money, which has the who has the capacity to move the market significantly. Okay, so in summary, a liquidity void is an area on a price chart where there was an absence of trading activity on one side of the market, often leading to a future visit to fill that void. Understanding and identifying this void can be a valuable tool in a trader strategy. And then the next one here in our list here is a vacuum block. Now, what is a vacuum block? A vacuum block, this is essential a breakaway gap that forms where, let me take it again. This is essentially a breakaway gap that forms when there is a sudden injection of volatility, causing a gap in price action. This gap represents a vacuum of liquidity because there are no trades occurring within that price range during the gap formation. Now, why the concept work? Liquidity and market behavior. The gaps are vacuum blocks indicate a strong directional move, often driven by a significant news or event. This gap can act as magnet for price to return to, or it can signify a strong trend continuation if the gaps remain unfilled. Now, let's go back to the chart here. Let me tell you the reason why we had this gap here in the market. Now, when you look at this gap here in the market, a lot of you here may be wondering, why did the market spike? Was it because the market was on fire? Is that the reason why the market spiked to the upside and gave us a breakaway gap? No, the reason is because there was actually a catalyst. There was actually a catalyst behind it. There was actually an information that caused the price to actually deliver this way. Now, what was the catalyst that happened was the tariffs of Donald Trump. Donald Trump implementing tariffs on every importation coming from Canada and Mexico, and also on China. By doing that, this thing has affected the global trading market. Okay, the global trading market is being affected by Donald Trump implementation of the tariffs on those countries. Okay, so it's going to affect the global trade, and when it's going to affect the global trade, this is going to come with fear from the minds of the investors. And also, let's not forget that the European central banks also cut 25 basic points from their interest rate, which is already leading the Europe currency towards a downward movement, a short-term downward movement. Now, Donald Trump coming out again on Friday and implementing these tariffs on Mexico, Canada, and some other countries, and then with 10% on China for every importation coming from them. This actually shows that the US dollar is going to be very strong, and the and the other currency are going to be weakened. But we don't know for how long, because if these other government actually apply the same the same um, rule, is going to also affect the US dollar. This is going to make the US dollar too very weak. If these other governments team up and start saying, okay, right now we have to trade by ourselves and we don't need the dollar, when they come to an agreement like that, which is already going on with BRICS, right? If they come to an agreement like that, that a lot of countries start backing up, stop like they stop using the dollar for the global trade and they start using their local currencies to trade. This is also going to affect the dollar. This is going to weaken the dollar. Because the reason why the dollar is buying currency right now is because of what is going on in the market. Now, if I should come here and show you the dollar index right now, you will also see this gap here. Because of what Trump implemented, that makes the dollar to actually spike up, which means it increased in the percentage of where it was to where it is right now. There was an increase in it. Okay, that is why the reason why we expect these gaps in the market. So these breakaway gaps always occur when there's a significant news behind it or event in behind it. Okay. Now, for the example here, we have bullish vacuum block. Imagine the market has been in the downtrend, and then a positive economic report is released. Okay, like for instance, say for the dollar, it was positive for the dollar, and then negative for a lot of other currencies. Okay, now when that news is being released, it will cause the market to gap up. This gap with a vacuum block, traders might expect the price to fill this gap by retracing back down to the gap area before continuing higher. If the gap is filled and the price then rallies, it confirms the bullish sentiment of that instrument. Okay. Now, when we look at this chart here, we have a gap here. Okay. When we look at this chart here, when you pay attention to it, there's a gap here in this chart. Okay. Now, the next thing you saw here was that price came back, refill in that gap. Now, this is a daily chart. Price took all this time, came back, refill in that gap, and then price deliver to the upside. Okay, so there's always a gap behind every price market movement. Okay, I said there's always a gap. I mean, there's always a catalyst behind every gap in the market. Okay, so in note here, you have to take note that this gap might not feel completely sometimes, especially if there's strong underlying trend or significant order block within the gap. And then we have the market context. Always consider the broader market contents and other technical indicators before making trading decisions based on vacuum block. So in summary, vacuum block is powerful concept in trading that help traders understand and anticipate price movement following significant gaps in the market. So I was thinking maybe I won't be able to cover everything in the internal range liquidity, but I just did, explaining what is fair value gap, explaining what is a liquidity void, and explaining what is a vacuum block. Okay, so the next one here is tips for using the internal range liquidity, which would be where I'll be stopping today. Okay, now the tips for using this internal range liquidity is: first, you have to identify the gaps and the void in the market. Look for areas within the current trading range where there are gaps or void in the market. These are potential areas where the market might move to fill those gaps, and then use higher time frames. Understanding that the higher time frame context can help you predict where the market is likely to go within the current trading range. And then you have to also combine with external liquidity. While entering trade based on internal liquidity, plan your exit based on external liquidity to maximize your profit potential. And then you also have to be aware of the gap risks. Now, be aware of gap risks, which is the risk that the market will quickly reprice to fill a gap, potentially stopping you out if you are on the wrong side of the trade. Now, assuming you were on Europe USD buy and then probably you did not set stop loss, eventually when that gap happened yesterday night, your account would have been wiped out because you do not consider the gap risks that might occur in the market. Okay, so whenever you are trading, you should be aware of the gap risks. So even though you don't feel like setting take profit and stop loss, you should, because you might not know what will happen over the weekend before the market open, or you might not know what will happen at that moment that you have entered the market and left the chart. You might not know what news or event that might occur in the world that will drive the price to cause a gap. Okay? So by implementing your stop loss, is going to By implementing your stop loss is actually going to help you minimize the amount of risks you were supposed to take. And then the next one here is market condition. Ensure that the market is likely to remain within the current range. If the market is trending strongly, internal liquidity concept might not be as effective. Now, by understanding and utilizing internal liquidity, traders can better navigate the market within the current trading range, identifying opportunities for profitable trade while managing risks effectively. So this is where I will stop for today, okay? And I don't know if you have any question, you can bring it up so that I can answer your question before I leave the call.
All right, Mr. David, thank you very much for that insight, and we appreciate it. Well, even though you were a bit fast, but don't worry, I'm sure a couple of them must have been able to catch up a little. And however, if they don't do, I can take it up from there. But
Okay, Sam.
so please, if we have question, please let's throw it up to him. We still have probably 15 minutes of his time, so we can maximize it well. So if we have we have question, please let us throw it up to him now before he leaves. So I'm very sure you must have question. So if there's any, all of the liquidity void he explain, all of the liquidities he explain, fair value gap, gaps, void, and all of those things, breaker block, ask question where you need clarification. Then I'm very sure you'll provide answers for us. All right, please, guys. If you have question, please you can unmute yourself. But if you're in a noisy environment, you can use the chat box.
Just like you said, David was still very fast. We are still going over the last video. I'm very sure our questions by the time we are missing it. I'll watch that one and I'll watch our questions.
Okay, I think this is
Definitely.
what
David,
we'll do. I think this is what we'll do. We can go over David's class, the one he just did and the last one, and maybe I'll just try and
Yeah.
negotiate with him where he can just come and have a questions I mean answer question and answer session. So I really can't tell when, but when we have an agreed date, I will communicate with the class. But is that okay with you, David?
it's okay by me, sir. It's okay.
All right, so we'll negotiate and we'll talk about the date and we'll let you know. So I think that is okay. Is that okay, Mr. Sampson?
Absolutely, absolutely. Thank you.
All right, so please, if you have question for now, let's throw it out.
Yes, also please help us upload this video as soon as possible so that we can
I've
so
okay,
be
yeah, I will do
prepared.
this. I've uploaded all of the past videos. Have you seen them? I didn't get that.
Yes, we've seen them.
All right, all right, all right. So in the absence of no other question, thank you guys, David. Thank you very much for joining us today. Guys, please, it is very important. So David, you can take your leave now. Thank you so much, very well. We appreciate you. So guys, that's very important. Like I said, that the best way we can maximize this thing is ensuring that we dive in well to this thing by practicing what we are learning. Like I said, an hunter without no bullet. It's just as if he went to play on the hunting ground. So if we're actually teaching this much and not practicing, it's gonna affect a lot. Disturb me with questions and all of those things. I don't mind if the questions are not professional or whatever it is. So we can always answer them. So please, and I hope by that we've had a very wonderful session. All right, David, you're raising your hand.
Yes, Mr. Francis, I could remember there was a time I asked a question regarding the best time frame to how do I answer that question? What is the best time frame to make to make analysis before taking a trade or before making an entry?
All right, so there's no best time frame to make analysis. As a trader, it is your job to analyze from all time frame because you analyzing from all time frame gives you the projection of what the market is doing. because if you are just analyzing on 5 minutes, you only see the short range of what price is going to do in the next few minutes. But so that's why I said there's something we call top-down analysis, which means you analyze from the top right to the down part of the time frame. So at maximum you start from like 4 days, 4 hours, 1 hour, 30 minutes, 15 minutes, 5 minutes. So very well you must have known the general movement and trend of the market um from 15 minutes, from 4 hours. You must have known the general major move of the market from 4 hours. And then once you see the destination of the market, then you know, okay, the market is generally on the uptrend, on the upside. Then you come to your lower time frame. Of course, we'll get there when we get to those ICT materials. So we'll start doing top-down analysis classes. So you analyze your top class, and from there you begin to explain. Okay, let me see if I can display charts. Alright, so you analyze from the top up down to this. So you take your entry from a lower time frame. Why? Because you actually need to trade within 24 hours. So you need to see an entry you can make and take out your funds in few minutes, from at least at maximum 3 hours. Whatever you are doing in the market, you are done, depending on how the market is moving actually. Sorry please, I often don't trade with my laptop, so it's actually rebooting. So now this is a 1 hour candle time frame. Okay. This is a 1 hour candle time frame, and now what I mean by top down, you have to go to from, let's say, 4 hours. So now you realize that generally market is now good. Now I love this, what I love what I'm seeing here now. So you realize that something happened, entered the market earlier this morning, as at I think midnight on Sunday. You realize that there was a massive gap. That was an effect of the fundamental update that Donald Trump caused, which has to do with some foreign policy information. Now looking at this now, you realize that generally on the 4 hour, market is on a downtrend, isn't it? And it has been doing this usual movement. If you look at it, this is where we are now. So this is what I'm actually expecting price to do. Look at it from a very big long time frame, higher time frame. Price did this, which is it's on a downtrend, higher lows, higher lows, higher lows. Now you realize that something happened here on a large time frame, which has caused a change of character, what we call a change of character in the market on a long time frame. Now price has traded back into this POI, which is the other block zone, the point of interest. Now, what was the reason of this? It could have taken price another 2 weeks to trade right into this place if it were not because of the market gap. If it wasn't because of the market gap, price would have taken like 2 or 3 weeks to trade right into this point. But because of the fundamental effect and push, that was what caused price to trade right into this other block zone. And the reason why I'm expecting an upside now is because price is within this range. So whatever makes this price whatever does not make this price hold, then price will start selling. So for as long as price hold at this zone, it will start buying. So I've seen a projection of what 4 hours is looking like, isn't it? Now you come to 1 hour. Okay, we are seeing the same projection in 1 hour now, but you can now enlarge your candlestick to see if this can project another meaning to you. But yes, it's just you're only seeing a range bound session. So let's just go to 15 minutes straight like that and look for a short. Now realize that price is still tussling within this very range since the market opening this week. So hopefully we are expecting price to break above this high. We're expecting price to come and break above this high, and that automatically means it's going to break. We're expecting it to trade into this market gap, at least 50% of it. We expect price to trade in to this place and preferably risks. So price trades into this place, then once it gets there, it sells again, and after selling, once it's selling, then we expect price to now come back, because definitely once price breaks this high, there's already what we call a break of market structure, because price has taken out liquidity at this top to trade into this gap. So once price, now my projection is this, price is doing this, so expect price to break here, right, trade right into this place, at least 50% of the gap, then trade back to this other block zone, then fly up. So this is a projection of what we're expecting. So now I've been able to get this analyzing the market from higher time frame up down to the list. Now I jumped from 1 hour, so you don't get to jump. You have to go into those places, read candles, analyze them, see possible obstructions, possible things that could obstruct market, things that you can sell, all those things. So right now we are waiting for a buy to break out of this place. Once a buy break out of this place and fills up this gap, everyone can short in a sell to trade in. Now this is our entry condition at the middle of this gap. Get it? Enter low first. If you are entry, like, enter like 0.01 first. Then if it keeps going, enter like 0.02. Then you stop putting your entries. Then you put your stop losses above the gap. So whatever makes it go as above the gap, that means it is going far up without coming down again. So, but at that point, price must react in this gap. It will come down. And once it gets here, our stop losses should be at this very particular zone, which is the last bearish candle responsible for the break of market structure. Are we all getting it right? I guess we are getting it right.
Yes, sir.
Yeah, so once price trades into this zone, then we begin to look to take major leads or buy. So once price trade back to this zone, you realize that this projection for sale is no longer needed again. Why? Because it has done its job. So the next thing we are now expecting is to go long, for price to reach here, then we drive like that. I believe I've made sense, right? Am I communicating? I said I believe I've made sense, right? Remember the initial projection was for price to sell from here, then trade back to this zone. So once price trade back to this zone, this from this very particular zone, we enter the next move, which is the buy. And what price just begin to do as we are as we've expected it to do. So I think that is what this is not fully what we imply by what do you call it, top down analysis fully. But by the time we begin to go a little with the ICT concept, we will understand better. So I hope that this answers your question, Mr. David.
Yes, sir.
All right, you're welcome. All right, so that's that about that. All right, so thank you guys for joining. The video will be uploaded before the end of business day today or tomorrow if network is favorable, because sometimes it takes the videos are up to like 5 gigs sometimes. So if it stops going, we'll have to start all over again. So I hope it uploads finish today. All things being equal. All right, guys. So do we have any more questions before we call it a day? Okay. In the absence of none, enjoy the rest of the day, guys. Thank you for joining.
Thank you.